All right. Good evening, everyone, to the Hurley Investments midweek commentary for May 22nd, 2018. If you wouldn't mind, really quickly, let me know if you can hear me. I'm going to start off today with talking a little bit about clients. I'm going to start with an article called "Client Risk Aversion Deepens." And it deepens amid trade war fears. This was printed back in, well, a month and a half ago. But just making sure that I present some information to you. And it looks like I should be okay. Anyone else, you can hear me okay? If you can let me know, type something in so I can go on. I want to start off today going over my fear that apparently also hits the clients. What do I mean by that? Well, if I go down to the bottom chart, client risk tolerance. Thank you, Rich. Thank you, Dave, Mary, and Lance. Appreciate it. All right, taking a peek at this chart, what does it mean? What does it mean when we see client risk tolerance sitting at 38.6? It means people are scared. Way to say that, Lance. Any other comments? I'm going to go ahead and I'm going to read the paragraph. At 38.6, the component tracking risk tolerance registered one of its lowest readings since the index started in 2012 and remained deep in contraction territory, extending a retrenchment that began in February. Readings above indicate increase, while readings below 50 indicate a decline. So it's a lot like the SM index, but it's scaring people is the best way to say it. It's the best way that people are going, you know what? This isn't working for me. As I take a look at their chart, asset allocations from bonds, equities. See if I can't make this a little bit bigger. Equities is the blue line. A lot of people in equities till January went from 66% all the way currently sitting at 52.6%. This explains the 4 weeks we had a big outflow of people out of equities. From the highs of this yearly running total at 57.0%, a lot of people have gone out of bonds. It's only 49.9% there. And obviously cash. People are moving more into cash. Beginning of the year, you did see some selling, and 45.8% have money in cash, which is kind of funny because, in all honesty, I finally got called out of some covered call strategy in the S&P 500. Just been doing covered calls. Started in January. Expected to be called out right away. And actually, I think I was. And then we ran off to February, March, and now April. Finally got called away in May. So I went through 4 months where I just shorted calls above my cost basis. Finally got out of my S&P at a price at around 270 and 10 cents or 30 cents. But look at the retirement advisor confidence. Back in December, it sat at 62. Retirement advisor confidence index sat at 58. It's now down to 50.7. And let me find the paragraph on that really quickly. Weighed down by the risk component, it can receive barely above the water, 50.7, a drop of 0.02 points. The component tracks assets allocation, investment products, selection and sales, client risk tolerance and tax liability, new retirement plan enrollees, and planning fees. Some advisors say rattled investors are reallocating to cash and to fixed income instruments. One advisor highlights the impact of retirement planning, saying clients are rolling over 401k plans to annuities and traditional IRAs with bonds because of the market activity. So in all honesty, I finally found some information that tells me, hey, the market is scared. This came from Financial Planning. It's for investment advisors, the May 2018 issue. You can find it at financial-planning.com. I do leave all of the links in, so if you want to, you can copy and paste it, and off they will go for you. But plain and simple, most easily said, the professionals are scared of the market. In fact, where I wanted to start off today, my thought is, what would you plan on doing during this year's summer doldrums? What do you think? What would you guys plan on doing during this year's summer doldrums? We had a couple more people that came in. Looks like it's Keith. Welcome, Keith. Vernon, you're here today. Nice to have you. Rich Abraham are here. Mary, looks like Mary just came in. We still have David and Lance. Nice to have you too. But what would you plan on doing during summer doldrums? And you know, Lance, I can always count on you, can't I? Kevin, why not sell in May and go away? So if I can go ahead, and I'm going to hit that one on first. Why, as an advisor, I don't sell in May and go away. In fact, let me go ahead and put that in here really quick, Lance. Sell in May and go away. So Lance, first problem is if you sell in May, are you ready to pay taxes? Anytime you sell, especially for some of your positions, are they short term? Well, it have to be short term if you're a sell and May go away kind of guy, right? You sold May and went away, taxes, you're going to have to pay taxes. Short term capital gains, especially if you got in November, December, you might be in 5 months and be like the S&P right now with a very marginal, if any, type of returns. And give me a quick second, because if I go to the S&P year to date, down 8, you got about a 1.80% return. It's almost 2%. Now, second problem with selling in May and going away, blue sky rules. You have to be out for the next 31 days. It's 30 days, you can get it back on the 31. If you get out in those next 31 days, you can't, if you get back in, excuse me, if you get back in the next 31 days, you can't claim the losses on this year's income. You still can claim them, but you have to wait. So the blue sky rules kind of kill you. What if I put this one in? What if you miss the summer run higher? Kevin, what are you talking about? What do you talk about summer running higher? That doesn't make a whole lot of sense. So let's change this. I'm going to change this to, let's see how many years I can get. I think it only goes 2 right out of the gates. Might go higher than that. But let's get the S&P 500 in here. So if I was to take just a bit, May till what? September, August? Where would you go? Kind of need to make that decision, right? So if I just take a quick peek at my last little timelines, what if I stuck a May? Probably went away at the end of May, right? And ran up to September. That's one run. May, in fact, if I can take this one, May into September. And sorry, not working for me as I thought it would. Into September, I have to move over here. So we missed that type of run up. And then let's go to, ooh, there's where you guys got me, right? So if I then take end of May to September, there's a big down one. So you guys can get me May into September. So if I take a quick peek at this, in all reality, you guys could say, well, you know, I don't want to miss some upward movement the last 2 out of 3 years. I don't sell in May and go away because the last 2 years have actually been pretty good, right? I think that would, I would hate to miss upward movement. So I could put in here 2 out of 3 years we've been higher, right? So I went ahead and said, hey, 2 out of 3 years we went higher. I don't want to miss it. What could you tell me? But 1 year was twice as bad as the other. So let's go back to it. All right. 1 year at the bottom fell out in April. In August, beginning of September. You are correct. And, you know, Lance, you could say I told you so. But right here, yes, the bottom fell out. So 2 quick things I could tell you, because my decision is, what do I do when we've had a pretty good run up, a pretty good run up, and we had a pretty good run down? So as a money manager, I'm looking at this and going, what do I do? Where am I going to put people's money, especially after we just had about $1.243 million come open from 4,100 shares getting sold out at roughly 1,270. Let me see how much exactly I came up with here. So 4,100 shares times 270 and 30 cents, $1.108 million. That was closer to 2. So I also had some other things that got called away. Don't remember what they were exactly, but I'm sitting on about $2 million of cash right now. And if I was going to say, hey, I'm worried about this possible movement, that really, if you take a look at it, you go all the way through May till the beginning of September, and it actually happens after September. So that's not really fair to say that. I should have said this is sideways. That is completely sideways there. So 3 out of 3 years, I'm in pretty good shape. I would probably, in all honesty, expect us to go sideways and then have a big drop this year, like what you see there in 2015. But I would probably expect that to happen in October. My trigger for what's worrying and what I'm scared about, what's on my timetable of is we have $500 billion of debt coming due that's going to roll off the Fed's balance sheet. Who's going to buy that new debt? We have the midterm elections that are going to be pretty much wrapped up towards the end of October. We have a rate hike coming. We have the Chinese using a gold-backed currency to trade oils in now. Kind of want to take some of our thunder from our reserve currency status. A lot going on in October, which wouldn't surprise me now that could see us having a down year in the stock market. So, Lance, to go back to you, in all reality, that downward in 2015 is really sideways. Well, it cuts it close. I guess the short answer is it cuts it close or it falls away in August. So I'm going to give it to you. But if I call or trade, I would love to see that type of action to be protected. To add it on. I'm a little more wary, a little simpler, sooner to add protection. So let's see if I wrote my question up here. So sell me and go away. Are you ready to pay taxes? Blue sky rules. What if you miss the run higher? So what am I going to do? And really, I'm probably looking at a covered call strategy going out to July or August covered calls. About the only thing I would not covered call, well, I was going to say about the only thing I would not covered call would be Apple, but I obviously don't see a one-time dividend being announced anytime soon. So yes, I'm going to try to collect a lot of credit for a 3-month period of time. So if we move sideways, or if I can take a peek, let's go back to our S&P chart now. Here's the current 6-month S&P chart, and it looks like we are developing a range that dates back to some highs in April, a little bit of gapping. We run into it right here. It seems like we have some highs with really the lower part of the range. You could say 270 with a line of protection at 26.75. So I see some protection there that I like. More so, I want to open up my chart just a little bit. And this gives me a little bit better understanding of where possibly my range is going to be really tight at this mark right here. And really what I'm justifying that off of is right here, small gap, right here. That kind of justifies where I'm going to be at. And what if I wrote a second line that coincides right there? Pretty narrow range. Looking at the 2717 range, which is going to come really close to here and really close to here. So we might be in a really tight range for the short time being. With all that said, obviously we do have some support, or should have some support, sitting down here at 26.75. But our market blew up on us today, right? Here our market blew up on us. What happened today that caused our market to freak out on us? What's the concern? Why did our market tank today? Why did our market tank today? There you go. Good job, David. Is that David? Good job, David. It dumped today because China trade talks. Now, I'm assuming you're talking about that Trump said he wasn't satisfied with these trade talks. So we still have headline risk in our market today. And it cost us roughly 200 points. I'm going to say 200 points. We finished down 170, 178, 88. But we have headline risk in our market today. The question is, how much headline risk is in your portfolio? And even with Baidu taking kind of a bit of a dip, now's the time to reallocate or reassess your headline risk. On $8 million, could you say and be okay with basically $5,500 of risk? Is that the amount of risk that you're willing to take in, today's kind of market? That is 0.00068% of a risk. Not a bad day. Yes, I was down today. It would be foolish to say that I'm up every down day in our market, because that's not how it works. In real life, a good investor is trying to minimize risk, and a good investor has something in your portfolio that is going to be a risk mitigator, something that will balance the playing field when you have headline risk in your market. Out of curiosity, what else do typical investors put into your account as a risk mitigator, or to mitigate the risk in your portfolio? Anyone know? Come on, guys. What do typically investors, there you go, 4 of you came in all at the same time. Bonds, right? Hey, we're going to mitigate risk with putting bonds in your portfolio. And you sit there and you go, well, for crying out loud, bonds don't really help out at all. And you're correct. Bonds aren't a risk mitigator, because the value of the bonds, since the last, really, to take 2 to 5 years, has been so low that you can get 3 times the amount of bonds, 3 times the amount of interest on your bonds than what you had 2 years ago, twice the amount than what you had 1 year ago. So you're getting churned out of your bonds, taking upwards to 10% loss as the value or premium on these bonds deteriorate. And as you see your financial advisor plug you into a program, hey, we got to rebalance you, hey, we got to put you into these other bonds, for all intents and purposes, you're all getting screwed. You're really taking a hit with bonds. Because of that, we're obviously suggesting, what else could you do? What would something more prudent be? Sometimes you'll have some tip shares. Sometimes you'll have some inverse ETF shares in there. In all reality, a lot of us in my business, meaning Hurley Investments, we're protecting with covered calls as a start and adding the long put to put you into a collar trade. What do you think of a preferred stock, A1 rated companies at 4.5 to 6%? So there's another thing. So Rich is asking me, what would you think about an A+ rating on company stock? It all depends where that rating came from, Rich. The only ratings that I would really care for would be a Moody's right now. They seem to be on the one that's more important because they got killed by not calling it last year. But an A1 rating is far from a AAA rating. So I would make the comment that if you're looking at 4.5 to 6% on an A1 rating, you're probably in some type of mix between high yield and or junk bonds. And I'm not saying that they are junk. I'm also not saying that they're high yield. They're worse than high yield, but better than junk. They're somewhere in the middle. There's no reason why companies shouldn't be at a AAA rating with both the tax breaks and the tax breaks and the cheap lending opportunity. If they're only a single A, it means they're holding way too much debt versus company assets, which means they haven't done a good job of managing their debt structure in this low interest rate environment, which is pretty sad. It's a missed opportunity by them. That's just my personal opinion. So with that said, what am I looking at doing? I want to get a little bit of protection here. I want some covered calls. I probably should have started adding them today. I might wait till we get a bounce up with Trump talking a little bit more on some positive news. If we do get something out of China, you could really see our market go up roughly. Again, I'm going to base this on a chart. You could see our markets roughly go up, not necessarily to new highs over summer, but at least up to the 2,800 mark. So probably another almost 4%. That's just an area that you're looking at. Keeve has his hand up. Keeve, do I need to unmute you? Maybe Keeve doesn't have his hand up. Keeve, do you want me to unmute you to make a comment here? You're welcome to type something in to let me know if that's what you'd like to do. But definitely I could see this back up to that 2,800 range. I don't think we'll go to new highs in summer because you just won't have the volume. Most of these guys just get in or excuse me, most of them get out and don't pay much attention to clients' portfolios through summer. Keith just let me know, nope, I hit on what he was going to say. So at least Keith and I are on the same page on what we're thinking here. Okay, so if I jump back up here, what's happening this week and why? You guys know, you should know, what's happening this week and why. I only ask it every week, right? There we go. Home sales reports. So we're going to have new home sales on Wednesday. We're going to have FHFA housing price index and existing home sales on Thursday. We obviously also will have durable goods on Friday, but most importantly is going to be the FOMC minutes on Wednesday. What is the FOMC thinking? We also have China trade talks with North Korea. Summit, what would I say? Summit attendance in the balance. Maybe they're going to happen. Maybe it's not going to happen. No one knows. End of the month happens next month, but we have Memorial Day. We have Memorial Day on Monday. So big money will probably be out by tomorrow. Memorial Day holiday. So big money will be out most likely by tomorrow or Thursday, but I would probably say tomorrow. We're going to see some lighter volume. And it's a 3-day weekend, guys. Nothing happens. Market's closed on Monday. So we'll be playing a little bit of catch up next week. If you ask me where our markets are going to go at the end of the week, I'm going to say higher. Since today was news driven, if I again look at my chart, I would probably say that we'll see, this is the wrong chart, I'm going to go to the S&P, probably see a test down here at that 2,700 and probably a bounce back up with some good news. I'd expect our markets to go higher. Dow Jones Industrial Average, we've had our breakout. We are technically bullish for the first time in a while, 6 weeks or so. Have our crossovers all the way across the board. I also looked at a chart just looking at a range, and of course the S&P and the Dow are correlating pretty closely. 24,600 to the downside, 25,100 to the upside. S&P, we are also bullish. Hey, it looks like we're turning over. We do look like that on the RSI, but that does not necessarily mean that is correct. So still bullish on our S&P, and obviously going to our chart here on the NASDAQ, we are also bullish, but kind of interesting. We do have more of a possible range. And that possible range could be everything from 2458. You could use 2300, but it looks like it might be closer to that 2550-ish. Again, 2300, excuse me. 2300 could be a range, but you're probably looking more to that 7250-ish. That. So 7,300 could be your range to the low side, probably closer to 7,250-ish. Some protection at the 50-day at 7,201. Sorry about that. I'm not saying what I'm trying. The words won't come out of my mouth the way I want them to be. With that said, moving on, I still think May is going to be a flat month, taking a peek on the S&P. That means that, so I need to change that. We started down here at the 2660, 7220. I do need to change that. I'm going to change that till we'll probably finish more on the bottom. So I'm going to change that to a 2% up month. Earnings, our earnings season right now are retail. You'll see Kohl's, TJ Maxx, Urban Outfitters. We have Lowe's tomorrow. LB Rams, Target, Tiffany, Burlington, Best Buy I would call retail, Dick's Sporting Goods retail, Gap, Ross, Shield, which is Sears, Big Lots, Buckle. There's quite a bit, Foot Locker, quite a bit in the retail market. So we're going to see how strong retail is. Usually you don't get the big buys now. You'll see the big buys August, September. So retail stocks are better to go into after their next earnings. Their next earnings, they typically won't have great sales. Home Depot actually took a bit of a hit here recently. But if you're looking at retail, you let them get through the next earnings, which will come end of July, June, July, August will come end of August, beginning of September. You let those retail numbers hit your stock down lower, and at there you actually, there you go, correct, David, you buy the dips. You buy the dips on retail after the next earnings, which is end of August, September. Economic reports, not a whole lot is happening. FOMC minutes are your big push. Michigan sentiment is what Michigan is there, so I might as well type the whole thing in there for you. Michigan sentiment. Nothing happening internationally that caught my eye this week. And how am I looking to trade? Really, I'm looking at longer term, July/August covered calls. So that's what I'm trying to accomplish, is get some protection there, and then obviously add puts as needed. Gonna play the game. I found a couple interesting articles I thought I'd tell you about. Two of the supposedly safest stock market strategies this year are doing horrible. Yes! $2 trades being on stocks with low volatility and ones with high yields. I wasn't going to say anything, Rich, in regards to your comments there, but this is generalities. Doesn't mean you still can't find some winners. But the short answer, low volatility, big blue chips, and ones with high dividend yields and or risky trade, so to speak, have been killing the market. I have actually seen live accounts that are down low double digits, 10, 11%, nothing more than 11.3. So I found something to explain why that is. When earnings are great, actually a really bad time to invest in stocks. The short answer is we now are creating a high benchmark for returns moving forward. It's maybe this is one of the explanations when I couldn't really understand why we were seeing banks do so poorly. They had such great earnings. I really scratched my head there, and I thought, for crying out loud, why aren't banks moving? Well, this could be the reason. Very interesting article. I would suggest you go through and read it. It also makes a quick comment, and there's a chart here that shows if you get a 20% return, you usually will see stocks decline by about 25%. It's almost better to have, I don't know. You know what? It's just history. I'm going to tell you to read the chart, enjoy it. And last but not least, hundreds of companies are now paying their employees student loans. The next catch to find good employees, apparently, is not necessarily giving them bonuses. It's going to be to pay off their student loans. To give them an extra $190 a month, it'll be added to a student loan balance, which is quite an interesting way to keep your people educated and to have them hold on to an employment or a job. I read an interesting article on Amazon, I believe, and it's from Bezos, where they actually will give people $5,000 to quit. At the beginning of the year, it kind of tests their fortitude. Hey, if you're interested in finding another job, we're going to pay you $5,000 if you've been here up to 5 years, $2,000 if you've only been there that first or second year, but they keep adding $1,000 on. And the short answer is we will pay you to quit. They're looking for engaged employees that want to stick it out for the long haul, that just aren't interested in the dollar. They caveat if you take the $5,000 to quit, you cannot be hired back from them. Kind of an interesting, interesting way to test your employees if they're willing to stay with you. And obviously, that client risk aversion deepens amid trade war fears. Put that in here as well. Questions? Any questions you guys have for me that I can answer that maybe I missed today? Any questions you guys have that I can answer for you? Let me give you a minute. Hopefully you guys have a great Memorial Day. And of course, Lance, you've always got a question. And David, you've been quiet today. Mary, you've been kind of quiet today too. But David, question said coming. What's your question, David? So now you are willing to put a covered call on Apple. What about the special dividend? So I have been fearful of putting a short call on Apple and finding out that they'll come out with a one-time special dividend of $20, $25. If I was to do a covered call on Apple, I would most likely be looking at something like, why do I have protection on? Let's I would most likely be going out to Apple, just have their earnings August. I probably wouldn't have June's. August, September. And Apple's next date, so I got to do a little bit of research, right? If I took a look at Apple's next earnings date is 7/31. So I could go out 2 months. I could look at options. Probably 200 is going to be a good day, a good resistance. August would be 3, July. I could only get $1.66 to July. Kind of doesn't pay to have an Apple covered call. What if I went out to August? 277. September's probably 450. $4, 385 to 390. So I might go out to an August. Give me 277, a little bit of protection. If Apple's to fall from 187 down to 185, I might make up, well, two strike prices. I could make up $1.77 on the way down. So maybe on Apple, I would be looking at 277. If it had a $10 special dividend, I'm still not at 200. It doesn't seem like they're going to, but yes. That is what I might be looking at for Apple. If I was looking on something more Disney, July, I want to do 100 on Disney. I could get a 5 to 550 credit in July on Disney at 100. I want to go to 110. 72 to 80. So I'm kind of seeing I'm going to have to go out to August to get the credit that I want to. August would give me $1.50 to 158. I don't know. Volatility apparently has gone down a little bit, huh? So changing what I've told you already, I will probably look for a volatility spike to occur, and next time it does, I'm going to do the best I can to try to short something a little bit out in time. I'd probably go out to, again, 150 is where I'd look for Disney, even though it's at 130. Not a whole lot of credit right now, so volatility has come down. I'm looking for a volatility spike to add covered calls. Good question there, Lance. You kind of caught me by surprise. Well, I guess that's not the fair way to say. I'm finding out that my numbers aren't adding up that would make me comfortable. Any other questions? If not, guys, I appreciate you being here. I will get this published here shortly. Thank you very much for being here today. I apologize for last week with kids finishing school and so forth. I just got, I ran out of time. Ran out of time for what I was trying to do last week. I apologize. I never even had an opportunity to get anything published for you, but I will publish the news that I prepared for last week. You guys take care. Have a wonderful day. Appreciate you being here. Look forward to seeing you next week, and have a great holiday. Bye-bye.